Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning, and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much more. How are you this morning, Tyler?
I'm doing well, Dean. How are you?
Great, thank you. What we're going to talk about today is risk. We're going to talk about, two categories of risk. First of all, personal risk that investors categorize themselves as, okay? So that's basically a risk analysis. And then we're going to talk about risk that is in your investment portfolio. Some people carry more risk based on their investments than others, but we'll talk about those two things. So to get things started, what we're going to look at here is individuals' risk tolerance. When people come into our office, before we talk about investments or anything else, we really need to find out what is the tolerance for risk that each individual investor has. So we go through 1, 2, or 3 page little questionnaire. And what that does do is it gives us an example of how much experience they have in investing, different types of investments, and also the risk they're willing to take. And it's sort of interesting. And Tyler, you've seen this with some of our clients too. They'll come in and I'll just quiz them. What do you think you are, a conservative investor, moderate, or aggressive? And we'll have some people say, well, I'm a conservative, very conservative. They'll go through the risk questionnaire and we find out that they might be moderate or moderately aggressive. We'll have some people say that they believe they're aggressive or moderate, and they'll grade out as conservative. So many times people really don't know what their risk is when it comes to investments. Sometimes they think because they're a conservative person by nature, based on anything but investments, that their investment profile would also be conservative, but it's not necessarily the case. So to jump into this, we're going to look at the different categories and what makes up those categories for the risk questionnaire and those people who fall into the risk. So Ty, let's take them through what we have here.
Yeah, and Dean, generally an investor will fall within one of the following 5 categories in terms of their risk. And we're going to start with conservative and then work our way on up. And right off the bat, I'm going to go in with conservative here, and conservative investors, they primarily seek to protect their principal over seeking growth. So in exchange for a higher degree of stability, generally conservative investors are comfortable with lower returns. And portfolios for conservative investors are generally invested in lower volatility assets. And we're going to be using the term volatility quite a bit here when we describe the different types of risk profiles. And volatility is a measure of risk. And assets that are volatile have the ability to change rapidly and unpredictably. So with our conservative investors, I just want to throw it out there that anyone can be conservative. If you're 20 years old or 90 years old, you can be conservative as an investor. But typically, we see people who are retired, age 70 or older, where their number one priority is to minimize volatility. That's our typical standard conservative investor that we see. And with that said, Dean, what might a conservative investor's portfolio look like when they come to us? They fill out a risk profile questionnaire. They grade out at conservative. How would we structure their investment portfolio?
Okay, good question. Well, first of all, when you look at conservative, you typically, as you said, these people are mainly worried about preserving their principal. So we have to take that into consideration. But we do need to put some growth into the portfolio so we can keep up with inflation and so on. Conservative is basically, as a rule of thumb, it's not an absolute because each individual person is different, but as a rule of thumb, about 80% fixed income and 20% equities. 80% fixed income. Fixed income is really the likes of bond or bond positions. So you could have a bond mutual fund or a bond exchange traded fund or actually hold the actual bonds themselves in your portfolio. as well as some cash positions or money market. That would fit into the fixed income. Now, I bring up bonds, but also you have to do your homework with positioning bonds in these portfolios because not all bonds are created alike. As a matter of fact, in today's environment, bonds are stressed a bit because we are in an environment that interest rates are going up and bonds are showing some instability right now. But you can go out there and put the best bond positions available for that particular client, about 80%. 20% are equities, and when people refer to equities, equities are typically an investment that's stock-based. So when people refer to equities, it's typically stock. Stock is going to give you more growth, but at only 20% in the portfolio, it is going to take a lot of the risk off the table. And the equity positions can be individual stocks. They can be stock mutual funds or stock exchange-traded funds.
Good. So now with that said, moving on up the risk scale, we go from conservative to moderately conservative. And moderately conservative investors, they desire to protect their principal, but they will also accept some volatility and risk to seek some degree of growth. And moderately conservative investors, they're willing to accept lower returns and they'll accept minimal losses. So these portfolios are generally invested in lower volatility assets, but they may contain a small percentage of higher volatility assets. And we usually see people who grade into the moderately conservative category as many different retirees who they want stability with some growth potential. It's usually a client in their 60s. They might be recently retired, but they seek to protect their principal, but they'll accept some risk to get some return. With that said, Dean, what kind of portfolio do we structure for the moderately conservative investor?
Okay, we typically pare back on the fixed income a little bit. And again, as a rule of thumb, not an absolute, about 60% fixed income. So those bond positions, whether they be in mutual funds, exchange-traded funds, or the individual bonds themselves. And we still hold cash and also money market positions there. So about 60% instead of the 80% as in conservative. And then 40% in equities instead of the 20% equities like we have in conservative. So moderately conservative, we have about 40% equities. Those equities, we typically like to rely on very large cap for a little bit more stability, but yet they still give you more growth opportunities than fixed income. So mainly large cap equity positions. We will put some mid and maybe a very small amount of small cap in there because small and mid cap typically carry a little bit more volatility than large cap, but we still have to pursue some of the growth here. So 40% equity positions. Again, equities are stock-based. And if you're just tuning in, I'm Dean Listle. I'm here with Tyler Listle. We're financial advisors with Secure Retirement Solutions located on Allied Street in Green Bay. If there's anything here that interests you and you'd like to get a hold of us, you can call us at 920-347-9888. Or for more contact information, you can go to our Facebook page. My Facebook page is Dean Listle, Listle, Secure Retirement Solutions. And Tyler's Facebook page is Tyler Listle, Secure Retirement Solutions. Okay, Tyler, why don't you take us into the moderate risk profile?
All right, so we covered the conservative investor, the moderately conservative investor. Now we're on to the moderate investor. And moderate investors, they desire higher long-term returns, but they also want to reduce their risk. So these investors are willing to accept short-term losses in exchange for long-term growth. And portfolios for moderate investors generally seek to balance the assets between lower and higher volatility. So this is probably the broadest category. This is what we see plenty of clients fall into. Typically, we can have people in their 40s, 50s, 60s, 70s, 80s. All sorts of ages fall into this category because many investors, they seek balance over the long run. They want a portfolio that will provide growth potential without taking on excessive risk, and that's what moderate does for most investors. So with that said, Dean, what does the moderate investor's portfolio look like?
Okay, this is the first risk profile that we start taking on more equities than we have fixed income. So again, we pare back on the fixed income again to about 40%. Our equity positions, we build up to about 60%, again, as a rule of thumb, not an absolute. The equity positions we're taking on, like I said, 60%. Here we're going to be taking large cap, mid cap, small cap. We're also going to put a little bit of international positions into the portfolio if that market or that sector is producing. So this is, again, the first risk profile that we take on more equity positions here, and we reach out a little bit beyond the boundaries of the United States, outside of the S&P, the Dow, outside of NASDAQ, the Russell, and we will bring in some international positions.
Good. So we have conservative, moderate. Now we're moving on up to moderately aggressive. And moderately aggressive investors, they desire higher long-term returns and they'll accept significant amounts of risk. So these investors are willing to accept large losses in exchange for long-term growth, as protecting their principal is really less important at this point. And portfolios for moderately aggressive investors are generally invested in higher volatility assets with a small percentage of lower volatility assets. So typically with our moderately aggressive investor, they'll probably be in their 30s, maybe their 40s. And again, keep in mind, anyone can be moderately aggressive. You can have a moderately aggressive portfolio in your 80s. But typically, it's going to be people who are a bit younger. They have a much longer time horizon, and they can stomach large losses and market downturns just because, like I said, time is on their side. And with that said, Dean, what does a moderately aggressive investor's portfolio look like?
Okay, so we're really paring back on the fixed income to about 20% as a rule of thumb. Again, mainly bond positions, some cash positions. It could be also money market accounts. And then we have about 80% equities. Equities are really stock-based. They could be equity or stock-based mutual funds, also could be stock-based exchange-traded funds. But now what we're doing is we, again, are looking beyond just strictly large cap and outside of the indices here in the United States, such as the Dow, the NASDAQ, and the S&P. We are going into some markets, some international markets. We're also looking at emerging markets. Emerging markets are quite risky. In that many times there's not a lot of history around some of these emerging markets. So there, with the emerging markets, you're taking on more risk. You're looking also for more reward. And here we look at things outside of the typical investments in equity-based, and we look at alternatives such as real estate investment trusts at times, if that's important. So 80% equity-based, we're taking on significantly more risk than we did the other risk categories.
All right, so moving on to our final investor risk profile type, we have conservative, moderately moderate, moderately aggressive, and you probably guessed it by now, aggressive. So aggressive investors, they desire to maximize long-term returns and they'll accept substantial risk. So aggressive investors, they are willing to endure significant losses in exchange for maximizing their long-term returns. And portfolios for these investors are generally invested in primarily high volatility assets with little to no low volatility assets. So, Dean, these people are typically going to be in their 20s or their early 30s, and they have a ton of time on their side. They're willing to accept big market downturns, and they might actually look at those market downturns as opportunities to buy in at that point. So they want to capitalize on that, but they really are definitely going to be aggressive, definitely want that risk at that point. So what might an aggressive investor's portfolio look like?
Okay. Before I answer that, Tyler, adding on to one thing you just said there, typically people in their 20s, 30s, and so on, they have time on their side. Also, though, we see some of our clients come into our office. They might hold a number of baskets of investments, so they have different portfolios, and they have addressed their risk tolerance. They could be conservative or moderate, but then they take a smaller part of that large portfolio, break it off, and we might look at aggressive or moderately aggressive in an opportunity to try to pick up more gains. They understand they're taking on more risk, but being that it's a very small part of their total investment, many times it's a good tactic. But to answer your question now, you're all in. When it comes to aggressive, many times we're all into equity positions. And again, that could be just a pure dividend producing blue chip stock portfolio, all the way through stock-based and equity-based mutual funds and exchange-traded funds, as well as international and emerging market positions and alternatives such as real estate investment trusts. So at this point, you're all in. However, we do have a conversation when it comes to some of our clientele that has an aggressive risk tolerance, and that is if the market is relatively flat like it was in 15 and 16 up until the end of 2016, does it make a lot of sense to be sticking our neck out that far in portfolios that really aren't performing because the whole market is relatively lag. So at that point, it doesn't hurt to go through risk tolerance questionnaires a number of times per year just to make sure everything is on par. People's risk tolerance does change. So we will ask people to sit down and we'll go through a questionnaire sometimes multiple times per year.
Yeah, and Dean, you brought up a really good point there where there could be any given client, and they might have 3 different types of retirement accounts, and one might be moderately conservative, the other might be moderate, and the other might be aggressive. So any person, no matter what your age is, you can have different types of risk profile accounts. So you don't have to have only one account that is moderate or conservative or aggressive. You can have different accounts with different risk tolerances. So that's an important note to take away from that.
Okay, good point. Again, if you're just tuning in, my name is Dean Listle. I'm here with Tyler Listle. We are with Secure Retirement Solutions. We're investment advisors. We're located on Allied Street in Green Bay. You can get a hold of us by phone at 920-347-9888, or you can go to our website at srsplans.com. Now, Tyler, let's turn gears a little bit. We talked about individual risk profiles for the individual investor. Let's talk about risk in a portfolio. So now we're going to be talking about different types of investment risk. And the first one I want to talk about is the big one. Okay, this is one that people are confused about at times. We're talking about market risk. And the reason I say this is the big one is people tend to think that you can diversify enough to offset market risk, and really that's not the case. Market risk is typically something that's going to take the market whichever way it's going. It'll take most, if not all, investments with it. There's an old saying that we use in the office, and that is, high tide lifts all ships. Low tide brings all ships down. That's how market risk is looked at. So understand, anybody who's listening, if you're an investor, diversification really does not take you away from market risk.
Yeah, exactly. And Dean, like you said, market risk is simply the risk you take by having funds invested in the stock market. It's something that you cannot diversify out of market risk. And I just want to mention one of the most recent examples of market risk is from a little over a year ago, and that was the Brexit vote. And for those of you who may not know exactly what that was, the Brexit vote is where the UK, the United Kingdom, voted to leave the European Union. And the reason I bring that up is because after that vote had taken place, on June 24th, 2016, when the U.S. markets opened, the S&P 500 fell 3.6%, and that was in one single day. So as you can probably imagine, this was felt by pretty much any investor who held stock or bond market investments, regardless of the particular stocks or mutual funds or exchange-traded funds that you held. It was an event that affected the overall market as a whole. So there was really no getting out of it. Everyone felt the shock and the market risk, no matter what particular individual investments you held.
Okay, good point. Okay, we're going to go on from market risk. We're going to talk about inflation risk. People talk about inflation and inflation taking over as we get older. Inflation risk is really also called purchasing power risk because it takes away your purchasing power if you don't have investments that keep up with inflation. And sometimes we see this with fixed income accounts. People will get very, very conservative, very safe, they feel, but at the same time, they're not keeping up with inflation. And that can be a risk to a portfolio portfolio because you can then outlive that portfolio.
Exactly. And Dean, inflation risk is the risk that general increases in prices of goods and services over time will reduce the value of money and negatively impact the value of your investments. And inflation is measured by the CPI. That stands for Consumer Price Index, which it has a 10-year average of about 1.75%. That's the previous 10 years. That's what the inflation is, 1.75%. And that number will most likely continue to rise as interest rates rise. And the reason why I bring up the inflation rate is because we see a number of people that are hurt by this. For example, we might see a 75-year-old couple who is extremely conservative and they have all of their retirement funds in CDs. Now, the average one-year CD rate is no more than 1% right now. So as you can see, a couple like this, they won't even be keeping pace with the current rate of inflation, and it just eats away at their purchasing power over time. So we see our fair share of potential clients in this situation, and it's not because they only want CDs. It's primarily because they haven't sat down with an advisor to explore all options that may be available to them. So, for example, these clients here, they may be fine with going into the market. They may grade into a conservative risk profile. They may be fine with taking a little bit of loss, but yet they might want to at least keep pace with inflation too. So inflation is a risk that we see with a lot of elderly people who have conservative investments, but yet they don't keep pace with the rate of inflation.
Okay, good point, Tyler. The next one we want to talk about is liquidity risk. So we talked a little bit earlier about market risk. So to take some of your portfolio or money out of the market and put into a different investment is going to help you there from a market risk standpoint. So let's say you invest that money in real estate. And we do have a lot of clients who have real estate as investments. What that does do at times is create another risk. And in this situation, it would be called liquidity risk. And what liquidity risk is it's basically the possibility that an investor may not be able to buy or sell an investment quick enough to reinvest in something else. And it typically shows up in the form of real estate. We see that quite often. Again, the investment itself could be a wonderful investment. It could appreciate in value quickly, slowly, whatever it may be, but it's a good investment. But if you want to sell that property in a hurry to either reinvest or to use it because you might be in need of some money because of health issues or needing a roof or something like that, you cannot sell that investment quick enough. That is called liquidity risk.
Exactly. And Dean, like you had mentioned, the reason why liquidity risk is so important is because all investors need some degree of liquidity within their investments. Because if an emergency were to happen, like you mentioned, if an appliance goes out, car breaks down, a health issue, then they need that money to be able to quickly access cash. And one of the biggest frustrations of investors that we see is not being able to have access to cash when they need it, which is why it's important to create a plan in the first place so you're not affected by liquidity risk and so you have your 3 to 6 months of living expenses built up in your savings account. So really, it's all about being proactive and having enough liquidity in the first place, meaning having enough money in savings to be able to account for the unexpected expenses that arise during retirement.
Okay. Going on to the next one, we're talking about social, political, or legislative risk. Okay. This is basically a risk that legislation or a government can have new rules or policies that's going to affect your investment. And the one that comes to mind here, and I'm showing my age a little bit, is years and years ago, here in the state of Wisconsin, the drinking age went from 18 to 19 to 21. And at that particular time, if you were an investor and invested in some of the alcoholic beverage companies, let's say, you probably took a hit because that legislation, that new policy affected the stock price because they weren't able to sell alcoholic beverage to younger people anymore. So that was a decision made by the government, by legislation, but it affects you as an investor from your stock prices.
Yeah, and Dean, to expand on that a little bit, political risk in particular is the risk that the market is impacted by political or social events such as a terrorist attack, war, a pandemic, or even elections. And these type of events, whether they're anticipated or not, they can affect investors' attitudes towards the market in general. And the reason why we bring up political risk is because of how often we see it today. So whether it's the market reacting to Trump being elected, which it did in November, the market shot up. It's been a little bit flat since then, but it was reacting very favorably to that election. So that's a political risk. Or the threat of North Korea, there's always going to be some type of political risk that's affecting the markets in today's day and age.
That's right. And we're very social media driven right now. So understand that every time on the news you see something such as what's going on in North Korea, people immediately go to the markets and see how the markets are doing. So that is very impactful in today's marketplace. Okay, the next one we're going to talk about is business risk. Now, we tell investors when they come into our office and we look at, let's say, maybe a blue chip dividend stock portfolio, we tell them that we like to buy companies. We do our research. We like to buy the company, not necessarily numbers which represent the stock. You have to feel comfortable. You have to do your research and know that this company might put out a good product or service at a fair price, and they're addressing a need. If you do that, you go forward and maybe put that stock position into the portfolio. Well, understand that all of these stocks are created by a company and represented by a company, and those companies don't always necessarily make the best decisions. So business risk comes into play in certain portfolios. A good example is, Enron. Yeah. Years ago, Enron was a very, very large company. A lot of people invested in things like Enron, and unfortunately, due to some of their tactics and devious ways of conducting business, a lot of people were hurt. A lot of stockholders were hurt. There's also WorldCom, companies like that. So remember, anytime you are bringing investments into your portfolio, companies are creating these investments that you're able to then purchase into, but you're also carrying business risk because of it.
Good. Yeah, and Dean, now we covered a number of investment risks there, but I just quickly want to touch on, lastly, how to manage the investment risks. And it's important to remember that you can't completely avoid a number of market risks, but you can manage them. And there's two ways. The number one way is to diversify. And like I said, while you can't completely diversify 100% out of market risks, you can manage and minimize them through diversification, which means you spread your investments among different types of asset classes: stocks, bonds, mutual funds, annuities, cash, different sectors, whether it be energy, financials, consumer staples, healthcare, and also maybe a portion allocated toward international investments. So diversify, and it's important to remember, diversification does not guarantee a profit or protect against a loss in a declining market. It's a method used to manage investment risk. And then number two is to simply do your homework, educate yourself on the economy, on what's going on politically right now, and also before investing. If you want to invest in a particular stock or an industry, you want to familiarize yourself with that industry and just know what you're investing in before you begin to invest. And that same thing goes for international companies. If you want to invest internationally, you need to know the socio-political stability, the regulations, the economy, and other information about the foreign country before investing. So again, you manage investment risks by diversifying and then doing your homework and educating yourself.
Okay, good points, Tyler. Well, folks, that's all we have time for this week. We hope you enjoyed the show and hope you'll tune in again next week. See you later.
Thank you, Dean.
You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them at Secure Retirement Solutions on Allied Street in Green Bay. Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.